Well, who doesn't know that investing is the best way to build a secure financial future? But poor decisions can lead to a loss of your hard-earned money. So to avoid making poor decisions, you need correct information and a kick-ass strategy. Today we are going to learn more about bonds and other asset classes to help you plan a wise financial future. But before that, hey, I'm Shubham and I welcome you all to our knowledge series by SMEST Discover, where you can get smart about investing. Every investment avenue has its own sets of pros and cons. So one should always select their investments according to their preferences, goals, risk appetite, and of course the one with more pros. But why should you invest your money into bonds instead of FDs and mutual funds? A bond is a loan that an investor gives to a company or a government for a specified period of time in exchange of an interest payment, plus the repayment of the principal at the bond's maturity date. Whereas fixed deposit is an investment option offered by the banks and earn a predetermined rate of interest. Mutual funds have been around for the past few decades and are gaining so much more popularity among the millennials. Bet you would have heard of them. A mutual fund pools investments from various individuals and institutional investors who have a common investment objective. The pooled sum is managed by a finance professional called a fund manager, who invests in securities and assets to generate optimum returns for the investors. So let's have a closer look and compare these three asset classes. First, let's look at the pros and cons of the fixed deposit. Here are the pros. FDs have a flexible tenure, they offer regular income, and each deposit in the bank is insured for up to 5 lakh rupees regardless of the FD amount. Sounds good? Well, here are some of the cons. It is a low interest investment, has a lock-in period, returns are lower than the inflation rate, there is no increase in interest, the interest income is taxable, and there is a penalty for a premature withdrawal. Now let's look at mutual funds. Here are the pros. Mutual funds offer variable returns, diversification benefits, expert management, and diversifies the risk in your portfolio. But here's a long list of cons for you as well. Mutual funds carry moderate inflation risk, have high transaction charges, heavy exit loads, levies, annual management fees in the form of expense ratio are taxable, the returns get diluted from the pool of investments due to an underperforming assets, and mutual funds are not entitled to any returns in case of bankruptcy. Whew, that was a long list of cons. Now let's look at the pros and cons of the bonds. Offer higher returns with minimum risk, have no transaction cost, the inflation risk is very low, investors have a variety of bonds to invest in, there's no exit load, the returns are linked to their credit ratings, and the investor is entitled to the returns in case of bankruptcy. That's a lot of pros. Now let's look at some cons. The income is taxable, it carries lower credit risk and liquidity risk. Wait, that's it? Since there are numerous investment vehicles, it is normal for an investor to get stuck while selecting one of them. But if you're new to this investing world, it's likely that you're unsure where you should start investing. Hence, it is important to get a thorough understanding of each investment avenue, comparing each and investing in the one with the most benefits and the fewest disadvantages. Well, let's wrap up this video, but I'll see you in the next module. Visit smest.in and take the next step towards investing wisely. But before signing off, always remember, investment in debt securities are subject to market risk. Read all the offer documents carefully. For any queries on this video, leave a comment below and see you in the next video.